Hi, everyone. Welcome. Thank you so much for joining us today. My name is Sasha Bretz. I've been with Midland IRA for about 4 years now, and I am a certified IRA services professional. I'll be moderating today's webinar. We're going to do a panel discussion with some of the leaders from our company. And I wanted to just get started by saying a couple of things. So first of all, this panel discussion is for educational purposes only, and we will be taking questions and answering them as we go. And I just want to remind you that we are not fiduciaries. We're not giving tax, legal, or financial advice. So we do want to educate. A lot of the people on this panel today have many years of experience in the industry, and we'll be glad to share that with you. Also, I just want to share a quick bit. If you experience any trouble hearing the presentation, we're not going to have slides today, so you don't have to worry about not being able to see the presentation. But if you do have any technical issues, try refreshing the page. That seems to do the trick from past experiences. We're also going to have some mini sessions for questions. We'll do our best to answer those live after each section of the presentation. And at the end, we will do an open forum for questions. Anything that we don't answer on the webinar live, we will be sure to reach out and address those with each of you. And as always, you will get a copy of this recorded session. So, all right, I'm going to go ahead and get started by introducing our first speaker. So he's going to talk about different ways to buy real estate in a self-directed IRA. And Brandon Hall, he has been with Midland for about 16 years. And just a moment, I want to make sure I'm still on here and that Brandon is still here.
I'm here. Can you hear me?
Okay. Yes. All right. Great. All right. So Brandon Hall has been with Midland for about 16 years. He's the Chief Operating Officer. A couple of his achievements included finishing Cornell's Executive Leadership course, and he is also a CISP or Certified IRA Services Professional. Go ahead, Brandon, and introducing your topic.
Great. Thanks, Sasha. I'm glad to have everybody here. I know it's unique times we're in right now, but we appreciate every one of you. And hopefully we can give you some helpful information. During this current environment, we see a lot of people looking to diversify their portfolio, especially for those people that have all of their eggs in one basket. And when I say that, I mean the stock market. I know when I look at my 401k these days, it's more like a 301k. So I'm kind of glad I have some of my money in alternative assets. Here at Midland, for the last 16 years, we originally started as a CPA firm on Sanibel 25 years ago. We've since sold off that part of our business. And for the last 16 years, we've been administering IRAs. So we currently administer about 15,000 IRAs. That amounts to about $2 billion under administration. But we don't sell investments. So if you want to invest in alternative investments, you need somebody like Midland Trust Company to do the required tax reporting and record keeping. You can't buy assets like real estate through your traditional brokerages because they won't let you. Number one, they don't know how to make any money at it. And number two, they don't want to deal with the administrative burdens of closings and tax bills and insurance and tenants and all that good stuff. So we're really set up here at Midland to hold your non-traditional investments, and real estate is a prime example of that. I will say I'm going to talk a little bit about the 4 ways that we see clients buy real estate in an IRA, but there are other ways that you can own real estate-oriented investments. We have clients that do hard money lending, and their IRA holds a mortgage on a property. We have clients that lend that have partnership deals. Maybe the client has the money. Sorry, somebody had trouble with audio. Maybe the client has the money, but they don't have the expertise or knowledge on how to rehab and flip properties. So maybe they partner up with somebody who has that knowledge, and they have some sort of partnership agreement where they have some deal in place to split the proceeds however they design the partnership agreement. So we have clients that invest in real estate in non-direct ways, and then we have clients that invest in direct ways. So that's what I want to talk about, is the direct ways that we see clients invest in real estate. By far, the most common is a cash deal. So 85% of our real estate transactions are cash, where John Smith's IRA has $300,000 in it, and he buys a $250,000 piece of property. And the beauty of that is any transaction that happens in an IRA happens tax-free. So if there's any rental income or lease income, any sort of income at all, it all flows back to the IRA tax-free. Furthermore, it doesn't have to be a cash flowing property. We have clients that buy real estate, vacant land, for example, and that doesn't cash flow. They're just sitting on it hoping it will appreciate in value. And one day when they sell that rental property or that vacant land, they're not going to have to pay any capital gains because, like I said, anything that happens in an IRA happens tax-free. Now, depending on the account type, you may have to pay taxes when you take the money out of the IRA in your retirement years, unless it's a Roth IRA. But while it's building up and growing inside the IRA, there's no taxation at all. The other thing that makes real estate unique is the fact that, unlike your stock portfolio, real estate does tend to have expenses associated with it. And since the IRA owns the real estate, the IRA is responsible for those expenses. So Midland Trust Company actually cuts approximately 100 checks a day for our clients to pay their HOAs or their maintenance or property taxes, insurance, that sort of thing. But cash is by far the most popular form of real estate transactions that we have here. The second type of real estate transaction we see is called tenants in common. And that's typically where you have two people pooling money together. And oftentimes we found that it's spouses. So my IRA has $200,000 in it. My wife's IRA has $200,000 in it. We pool our money together to buy a property that's $350,000. We each use $175 in our IRAs, and my IRA has 50% ownership. My wife's IRA has 50% ownership, and we have to split all the expenses and all the income accordingly. So that's a common thing that we see with people who maybe they don't have enough money to buy the property that they want to buy, but their spouse does, or a friend or business partner. The third way that we see clients buy property inside of an IRA is through the use of an LLC. So typically, I don't think if you have an IRA that's worth a few $100,000 and you just want to buy one property, I really don't think it's worth the expense to form an LLC. You can just buy the property in the name of the custodian, Midland Trust Company, and have Midland pay the bills and receive the income from the property and put those payments back in your account. But forming an LLC can be advantageous for certain types of people. Usually when you start to have multiple owners of the property, especially if you're getting more than two, it can be handy to have an LLC because the LLC has its own checking account. And so you could pool money together from different investors, some of which might be IRA investors, some of which may be personal investors. But you can pool money together in an LLC to accomplish the goal of buying real estate, and the cash flow becomes a lot easier if there's one checking account in which money flows to and from. The other time the LLCs tend to make sense is if you're combining IRA partners with non-IRA partners. So let's say I wanted to use my IRA, but my wife didn't have an IRA, so she wanted to put some personal cash in. Well, now Midland's got to pay the expenses associated with my IRA. My wife's got to pay her own expenses. We've got to figure out how to get those checks together. Same thing with the income. We rent the property out. The tenant's got to write a check for half of the rent to Midland Trust Company for the benefit of Brandon Hall, and the other half to my spouse. So it just becomes more convoluted when you start combining IRA money with non-IRA money. So that might be another instance where it's easier to form an LLC. The LLC could then buy the property in its own name, and then at the end of the day, when the LLC disperses, half of the proceeds would flow back to Midland Trust to be put in my account, and half would go back to my spouse. Of course, hers would be taxable because she didn't use her IRA, unless she does a 1031 exchange, which we'll touch on later in the presentation. And the fourth way that we see, the fourth way that we see clients buy real estate in an IRA is pretty uncommon. And if I ask most of you on this webinar whether an IRA can take on debt, can an IRA borrow money from a bank, most of you would probably say that's not really possible, or you don't think that it is. An IRA actually can take on debt. The IRS does require that debt be called what we call non-recourse financing, which basically means there's no personal guarantee or personal pledge of assets. So you cannot get traditional financing if you're using IRA money. You can only get non-recourse. Now, because of that, you're limited on the number of lenders that will do those types of loans. Most lenders, they want that protection of having collateralized assets. We do know of some banks that'll do these for our clients, and we'd be happy to pass that on if it interests you. Most of these banks are going to require at least 40 to 50% down to protect themselves from a market downturn. Furthermore, the IRA is the entity that's taking on the loan, not you. Your IRA is a separate entity from yourself. And so the IRA is going to be responsible for the mortgage payments. So the bank's going to want to know how the IRA is going to cash flow to be able to make those payments. So you're not going to see a non-recourse loan on a piece of vacant land, for example. It's going to have to be a cash flowing property. And then lastly, and this is probably the primary reason that we don't see a lot of these transactions, but the IRS really doesn't like the idea that your IRA can borrow money to help itself grow faster than it can on its own. So basically, they tax the portion of the annual income on the property that's derived from the loan, that's attributable to the loan. So I'm not a CPA. I'm not going to get into that today. So you probably want to talk to your CPA. But anytime an IRA takes on debt, a portion of your income is going to be subject to what we call unrelated business income tax, or UBID tax for short. And you're going to have to file a tax form 990T, 990-T, and then your IRA may have to eat some taxes to do that. But it is possible to have an IRA take on debt, and depending on how well the investment does, we have seen it work well for some clients. I do want to throw out one more thing for any of you that are self-employed with no employees. There is a retirement account called an individual 401k account, or sometimes they call them solo Ks. And the UBID tax that I just referenced only applies to IRAs. It does not apply to 401k accounts. So if you are self-employed and you have interest in doing a non-recourse debt financed property, it might make sense to do that inside of a solo 401k rather than an IRA. So you could talk to some of the Midland associates about that. But the UBID tax, I just want to be clear here, the UBID tax that I was referring to only applies to property that's being purchased with debt attached to it. And 99.9% of the clients' transactions that we see are cash deals or cash partnerships. And so this UBID tax typically does not apply. Sasha, did you have any questions that you wanted to ask?
Yeah, Brandon, thanks. I was just going to read a couple frequently asked questions, and then we have a question or two from our listeners. So you touched on non-recourse loans, and I was wondering, this is a frequently asked question, what are the pros and cons of using a non-recourse loan in an IRA?
Well, I'll start with the pros. So the pros, it could allow you to do a transaction that maybe you couldn't do before. Maybe you don't have the capability of pulling in a spousal IRA or a business partner. So it might allow you to do a deal that you couldn't do, that you really wanted to do. Also, it could give you the opportunity to leverage into multiple properties. I know I had one client one time, he had about $500,000 in his IRA, and rather than buying one property for $450,000, He bought two properties at roughly 250 a piece and leveraged half of each. So he was able to do that. I guess the downturn or the con to doing that would be if you start leveraging properties all over the place in a bad market, you could really get yourself into some trouble. I already mentioned the UBID tax that applies to the percentage of the income that's attributable to the loan. And then I guess how you feel about debt in general. If you're a Dave Ramsey disciple, for example, debt is a bad thing. So maybe that would be a con as well, if depending on how you feel about debt.
Okay. Next question. What are some things to consider before using an IRA LLC?
I think really when it comes to the LLCs, it's all about cost versus control. There's a formation cost to set up the LLC. It's not necessary for most clients because they're just buying one property and they're paying cash for it. For example, Midland charges a check writing fee of $5 a check to pay a bill. It takes a lot of $5 checks to add up to the cost of forming an LLC. We do have a side sister company that we set up LLCs for clients all the time, and we charge $695 plus whatever the state filing fee is in that particular state. I know there's a lot of attorneys in town that can create them. They usually charge well over $1,000. So the cost is definitely one thing, but it also does give you control because that LLC has its own checkbook. You don't have to go to Midland every time you need a bill paid. You can pay the bill straight out of the checking account. It also works well for clients that have multiple assets. And I'll just throw this out here. Let's say somebody has 5 pieces of real estate. Well, Midland would charge $295 a year for each of those assets that were on our books. If they held all 5 of those within an LLC, there's only one charge from Midland for $295 because there's only one asset on the books. What that LLC holds inside, a lot of times we don't even know. So you can get yourself into some trouble with that too if you don't know what you're doing, because there are what we call prohibited transactions and disqualified parties. There's certain things you can't invest in and certain people that you can't transact with. And if you're doing transactions inside of an LLC, you really need to know what you're doing. But it's all about cost versus control. If you're just, like I said, if you're just buying one property, it's probably not necessary. But if you have business partners or you're buying multiple properties, it could make sense.
Okay, that's very helpful. Thank you, Brandon. And we do have just a couple of questions here from attendees. And maybe you can answer this, or you may direct them to another professional, but what kind of landlord liability protection do you have with properties in a self-directed IRA, assuming it's not in an LLC?
I wouldn't know the answer to that question. That's a landlord liability would fall to an attorney, I assume. So.
Okay, that's fair. So, Jonathan, if you would just reach out to a tax attorney or a CPA or a real estate attorney, they may be able to answer that question for you. We've got one. Can I buy my own rental property to put in an IRA?
If you already own the property, there are rules that prohibit moving that property into your own IRA. So basically the rules state that you can't transact with yourself or any lineal relatives. So your parents, grandparents, children, or grandchildren. So you could buy a new property in partnership with them, but you can't buy from them. So you would not be able to take something that you currently own and sell it to your IRA or vice versa.
Okay, and then we'll just do one more, Brandon, before moving on. Could my partner and I use our self-directed IRA to purchase a new home for ourselves, for us to live in?
No, then that's another one of the rules with IRAs is the IRA is meant to benefit you when you retire. It's not meant to benefit you now. The IRS doesn't like the idea that you're going to benefit from something that taxes have not been paid on. So IRAs are meant strictly for investment. So the property would need to be for investment purposes only, not for personal use. I know we're probably going to get a ton of questions here, Sasha, but for the sake of time, and we have a lot of speakers here,
Yep.
I promise we will go through all the questions if we don't answer your question live, and we will get back with each one of you if we don't cover it.
Okay, thank you, Brandon. I'm going to go ahead and introduce our next speaker. Her name is Kelsey Deneen, and Kelsey is going to speak a little bit about Roth conversions. Kelsey's been with Midland for 10 years. She is the sales director and is also a certified IRA services professional. And Kelsey, go ahead and take it away with your topic.
Yeah, sure. So today's webinar was specific to retirement strategies to diversify your self-directed IRA. So Brandon had a really good summary about diversification through asset type. So, maybe I'm diversifying into alternatives, by buying real estate, things of that nature. So as stock and equities markets start to get a little shaky and people get nervous with, the stocks, bonds, and mutual funds of the world, a lot of people think of diversification, number one, as just shifting some of their assets out of stocks and bonds and into alternatives. So like Brandon touched on, real estate is a huge investment asset class here. By law, the only two things you cannot do in your IRA are life insurance and collectibles. So as you can imagine, the number and different types and asset classes you could invest in through an IRA here are just huge. I mean, it could be anything. It could be precious metals, futures, forex, real estate, private lending. So the first thing to consider is asset class. What am I going to invest in that is going to diversify my current stock or bond portfolio? Now, Brandon summed up pretty well how the real estate diversification would work as far as investing retirement funds into real estate. A case study that I had thought of when we talked about diversification beyond just asset types is basically tax diversification. So again, we're not a CPA, be sure to consult your specific tax advisor on your particular scenario. But I just wanted to share my personal kind of case study that I think of when I think of diversification. So I was with Midland during the last real estate downturn, and I'm sure if you guys have been in the real estate industry long enough, everybody recalls, it's the 2006 to 2012 era when the real estate market had a major downturn. So when that happened, what we saw is people were looking for opportunities. So there was a lot of crisis in the markets, and they were saying to themselves, okay, well, how do we make lemonade out of these lemons? So I thought it was very interesting to see people actually doing Roth conversions at that time. So if anyone's familiar with Roth conversions, what that is if I have a before tax account, like a traditional IRA or traditional 401k, or maybe even a SEP IRA, those are before tax, meaning the money I put in there, contributions, I usually get a tax deduction on. So it's lowering my taxable income. I save the tax money. I basically get like a tax credit. So I have a deduction. All that income is before tax. When I'm ready to do a Roth conversion, I'm actually changing that account from before tax to after tax. So when I move my funds into a Roth IRA, I'm paying the taxes because that account had been pre-taxed previously. So a Roth conversion is where you actually say to the government, hey, Mr. IRS, I would like to pay the taxes and move my funds from my traditional IRA to my Roth IRA. Now, why would people do that, especially in the downturn? There was actually two major factors. So the first one is because the real estate market had declined so steeply, they were saying to themselves, okay, well, I could either sell this property out of my traditional IRA and take the loss because it's now worth less than what I originally bought it for. But other investors were saying to themselves, well, hey, maybe this is a really good opportunity for me to do a Roth conversion. And not a conversion on the sales proceeds. We're talking an in-kind conversion. So what that is my property maybe is now worth half of what I bought it for. Instead of selling it and taking the loss, I'm going to convert the property itself. I'm going to move it out of my traditional IRA and into my Roth IRA. And I pay taxes on the Roth conversion at the current fair market value. So what people were looking at is they were saying, okay, the value of the property has decreased. Now, if I do a Roth conversion, I'm going to pay a tax bill on a smaller amount. So easy number example, if I bought the property for $200,000, we hit the market downturn from the real estate crisis, it's now only worth $100,000. If I move that property out of my traditional IRA into my Roth IRA, I'm now only paying taxes on 100,000 instead of the original 200. So people were basically looking for ways to take advantage of the downturn, which I thought was very smart. If you didn't want to sell it, you just wanted to, be a buy and hold investor, I could do a Roth conversion of the property, get it into an after-tax Roth IRA, pay a smaller tax bill since it's, a smaller fair market value right now. And then in the future, when the market recovers, it's after tax. I basically prepaid the tax bill at a lower rate because the property, when I did the conversion, was a depressed value. So Roth conversions were very interesting. It basically saved them tax money by using the timing of a lower market value. The other reason we saw a lot of those in the 2010 era was previously the IRS would not let you do a Roth conversion if you had a certain, modified aggregate gross income over $100,000. But there was actually a tax law called the Tax Increase Prevention and Reconciliation Act of 2005. That tax law, for whatever reason, basically said that income restriction for Roth IRA conversions is removed effective 2010. So we saw a huge increase in the number of Roth conversions in 2010 because now people who earned more, who were previously not eligible to do those, were now eligible. And then, like I said, the real estate market was very friendly to Roth conversions because you were converting at a lower value, but still keeping the exact same asset. It was the same property. You were just moving it from your traditional to your Roth and getting to pay taxes on a lower value. So in summary, basically, these clients had already diversified their asset classes by investing in real estate, and now they were able to diversify further from pre-tax retirement accounts to post-tax retirement accounts by having maybe both a traditional IRA and a Roth IRA now holding alternatives. And then lastly, the Roth conversion was very appealing to certain investors. So if you thought maybe your tax rate was going to be higher in the future due to future income streams that you had, it was attractive. If you expected the government to raise tax rates in the future, some people are very concerned with the national debt, and they think to themselves, the only way the government's going to collect, enough tax money to satisfy those debt requirements is by eventually increasing taxes. So that was very attractive to them. Or maybe perhaps right now you think you're in a lower tax bracket than you will ever be. Taxes were lowered here recently for many individuals. So, Roth conversions are starting to look pretty good to them now. Or maybe if you were going through a period of unemployment or you had losses, you had those deductions, lower income, you could do conversions at lower tax rates since you fell into a lower tax bracket. And then the last item was people who wish to avoid required minimum distributions. So everybody knows if you have a before tax account, like a traditional IRA or a SEP IRA, you've never paid taxes on any of that money. Eventually, the government wants their tax money. So they've actually recently updated the age for required minimum distributions to 72. That was just recently here through the Secure Act that was passed in December 2019. So as of 72, the government, the piper comes calling and they want their tax money. If you've converted to a Roth, you've already paid the tax bill. So you have no RMDs. So you've essentially prepaid the RMDs. You have no further tax bill to pay. Everything grows tax-free at that point thereon, and you don't have to worry about the RMD issue. So those are all reasons people look at Roth conversions. And again, it's specific to you and what your tax rate is and if you have any losses for the year. So it's very specific to each individual. Be sure to consult your CPA or tax advisor. But I thought it was very intriguing that people would use a market downturn to take advantage of Roth conversions and basically save themselves some tax money.
Right, that is certainly interesting. Thank you very much, Kelsey. I'm going to ask again just a couple of frequently asked questions related to Roth conversions. The first is going to be, can a Roth conversion be undone?
That's a great question. So originally, years ago, the answer was yes. They would actually let you do what they call a recharacterization. However, as of the passing of the Tax Cuts and Jobs Act of 2017, that legislation barred recharacterizing Roth conversions. So the answer for anybody who does a Roth conversion now is, unfortunately, once you convert, once you decide to move it from a before tax to an after tax account, you cannot undo it. The government will no longer allow you to recharacterize a Roth conversion.
Okay. Another question. Do I have to sell my assets to do a Roth conversion?
Great question. So a Roth conversion, we're doing an in-kind conversion. That's specifically what I was talking about when I mentioned real estate investors who are taking advantage of the decrease in valuations for their real estate assets. So no, you do not have to sell the asset. What you're doing is you're basically, with a real estate asset, for example, is you're getting a fair market value of the property, and most people do that through a certified appraisal. The certified appraisal comes in, says your property is worth, let's say, $100,000, whatever it might be. $100,000 is basically your Roth conversion amount. If I were to convert 100% of that property to my Roth IRA, I would be adding $100,000 to my earned income for the year, and I would have to pay taxes on that. Now, some people choose not to convert all 100% based on what their CPA tells them and kind of playing the game of optimizing their taxes. Maybe they only want to convert half that year. So it's possible to have a traditional IRA here that holds 50% of a property and only do a Roth conversion on 50%. So you have that certified appraisal showing the value. You have a quit claim deed deeding 50% of it to your Roth IRA. And then you have a tenancy in common where my traditional IRA owns half, my Roth IRA owns half. I only pay a Roth conversion amount of $50,000 now because I only converted 50% of the asset. So hopefully that makes sense. So it's not selling an asset because you don't want to take the loss if the value's decreased. It's doing a Roth conversion in kind on that asset. So you can still own it. You just can basically prepay the taxes at a lower rate.
That's a perfect explanation. And we did get a question in how can you convert half? So if you don't mind, I'll just, I'll take that one. So you would just need to get an appraisal and a quit claim deed if we're talking about real estate. So you're basically taking the deed that has your IRA as the sole owner and getting a deed done by a title company or an attorney just to reissue the ownership. So it would be a split ownership between yourself and the IRA. So great questions. I think we're going to move on to the next topic. Thank you, Kelsey. And I'm going to move over now to Teresa Noer. She's going to talk about 1031 exchanges. Teresa's been with Midland for 14 years. She's a senior vice president. She is a CISP, a certified IRA services professional, and a certified exchange specialist, one of the few in Florida, actually. So go ahead, Teresa.
Well, hello, everybody. Thank you, Sasha. For my portion of this discussion, I'm going to veer a little bit off of the current course that we're on, and you'll understand why in a minute. But let me just start off by discussing a case study that I like to share with people. We had a prospective client who was considering setting up a self-directed IRA to buy real estate. And we were doing the preliminary discussions with him. And it turned out that ultimately what he wanted to do was have his IRA purchase property that he currently owned and operated his business out of. And if some of you will recall earlier, Brandon had mentioned that's one of those prohibited transactions that's just not allowed. So rather than cutting the conversation short there, we decided to go a little bit deeper into trying to figure out exactly what this client wanted to accomplish. Turns out he was selling his business property because his business was expanding and growing, and he needed a bigger space to move his company into and continue to add more members of the team. So one of the things that we threw out there was, well, kind of sounds like you might be an ideal candidate for a 1031 exchange. You're selling investment property or business property, and you're going to be buying more business property. Did you ever consider that? And he had no idea what that was. He had never heard of it. No one had ever really talked to him about it. So we explained the gist of it to him and suggested he talk to his tax advisor about it to see if this was in fact the best course of action. For those of you that are not familiar with what a 1031 exchange is, again, this is a completely separate strategy from self-directed IRAs. It's basically, I like to call it a gift from the IRS. Yes, I said it's a gift because it is geared for real estate investors and business property owners who are looking to defer taxes on the sale of their investment or business use property by acquiring usually more expensive investment or business use property. So that's one of the key requirements of an exchange, is that in order for this to work and in order for you to have the opportunity to defer taxes, you've got to be selling investment or business use property and acquiring more investment or business use property. So back to this client, this is exactly what he was doing. And so after consulting with his tax advisor, he figured like, hey, this is pretty cool, because I didn't even anticipate that I would have an opportunity to defer the taxes on the sale of my property. So, okay, let's do this. He was able to get his current property under contract. He was able to get a new property under contract and had it all set up to close within a couple weeks of each other. So he was going to have everything wrapped up nice and tight with a nice little bow. The stars were aligning. And then Hurricane Irma hit. And it, just like with everyone else that was affected, it threw him for a loop as well as his plans. And so what ended up happening was the sale of his current property fell through, but he still had his current property under contract and he was expected to perform on that contract. So luckily he had access to some cash to get the purchase done, but there was no way that he was going to be able to get another buyer in place for his existing property before he was supposed to close on the new purchase. At that point, he just figured, well, you know what? We tried, didn't quite work out. Thanks for the help. And he just figured he was out of luck. We were thinking about the possibility that, listen, if you're willing to stick this out, there is an opportunity for you to do what's known as a reverse exchange. And basically, it would allow you to close on the purchase before you close on the sale of your existing property. Hence the name. Get it? Reverse, buy first, then sell. So at this point, he was like, I've got nothing to lose and everything to gain by trying this out. So he did. He set up the reverse exchange. And keeping in mind, he only had 180 days to get this wrapped up. So he had 180 days from closing on the new purchase to get his old property closed to make the exchange work. So again, this was after Irma, and so a lot of things were a little bit uncertain and a little slow to get back to some sense of normalcy. So he wasn't entirely sure that he'd be able to find a buyer and get it closed within that 6-month period. We were all really pulling for this guy, and he eventually got a buyer for his property, and the closing took place literally, I think it was approaching 5 o'clock on his 180th day. I've never seen anything like it. Like, we were not sure that this was going to get to the finish line, but it's incredible how all parties involved got it together, rallied together, and did this so that this gentleman could actually complete his exchange. So my point in sharing this case study with you is sometimes people start out in one direction, and you know, he had every intention of setting up an IRA, thinking that the self-directed IRA was going to be the best strategy for him and his situation. And it turned out that there was an even better solution waiting for him with the 1031 exchange. Every situation's different. He just happened to check all the boxes for a 1031, and we were really glad that it all worked out. So just because you hear no, there might be an even better yes waiting for you. And that's the moral of the story. Back to you, Sasha.
Thank you. I love that. I'm going to ask a couple of what I believe are frequently asked questions for you now.
Okay.
What would have happened if the client was not able to close on his sale by the 180th day?
It's a good question. That is a frequently asked question. And so kind of like a good news, bad news situation. Good news is he would own both properties. He wouldn't have any tax liability because no sale took place. Bad news is that new property could not be identified as replacement property for a future exchange. So he would have the opportunity to do an exchange on the sale whenever it eventually goes under contract and he has a buyer for it. But unfortunately, that new building or new property that he bought is no longer a viable replacement property. He's going to have to go out and find a new replacement property to make the exchange work.
Okay. What if the investor had to finance the new purchase? Would that have an impact on the ability to do the reverse exchange?
Sorry, I forgot it's video. Yes, somewhat, because traditional financing is, I'm not going to lie, it is difficult to get that done. It's not impossible, but it is difficult to get financing on a reverse exchange because of the way that they're structured. It's a class all on its own, but there's just a lot more involved in it. And you need to have a lender that understands what the taxpayer is trying to accomplish, who's taking title, and all the inner workings of it. Now, if you know someone who's not a disqualified party that has a self-directed IRA, then they might be able to loan some money to this particular taxpayer and do it quickly. Because that was the other issue, is he only had a couple of weeks time to get the new purchase closed. There was no bending on that one. So to try to go the traditional financing route would have been even more difficult than it is under normal circumstances. So keep that in mind. I think Brandon mentioned it earlier that one avenue that people could go into is to loan funds for real estate purchases if they don't want to do the direct real estate purchase. So if somebody's in a bind, if someone else has money in their IRA, they could have stepped in and also saved the day and loaned the money for this purchase.
Okay. Well, thank you, Teresa. And I think that gives us an excellent introduction to our next and final speaker. Amanda is going to talk about the relationship between IRAs and 1031s. And Amanda Bermudez has been with Midland for 12 years. She is a senior vice president. Amanda also achieved the Cornell's executive leadership and is a CISP. Amanda, let's hear it.
All right. Hi, everybody. Thanks, Sasha, for that introduction. So I'm Amanda, and I'm just going to start off by saying I normally work on the IRA side of things, so this is kind of exciting for me. I'm going to say a different situation to kind of piggyback off of what Teresa talked about. So I see some existing clients there that have logged in, so it's really good to see you guys. I'm going to give a case study today. It's interesting because I asked my team, what are some really cool things that you guys have done lately? And I actually didn't know that this one happened, and I was so excited to tell you guys about it. So this is actually a transaction where we have IRAs and 1031s intersecting, which is pretty unusual. So in this case, we had two clients, a husband and a wife. They were doing a 1031 exchange, and they wanted to combine some of the proceeds from that sale in conjunction with an IRA transaction. So in this instance, the clients had a rental home in California and they wanted to purchase a property in Florida. So after the sale of the California property, they purchased this new property in Cape Coral. They were able to equalize their exchange. So all the gains were deferred on the California property. The really interesting thing with this transaction is that when they went to purchase the replacement property, they actually did it so they were purchasing 86% personally. Husband's IRA purchased 14%. So instead of them having to get additional financing when they purchased a more expensive property, the clients were able to use IRA money for the difference. So I thought that was a very clever solution to avoid financing. And also internally, it was really interesting for us to sort of see the two teams intersect. So in this transaction itself, there were a few hiccups. This transaction, the property was sold and then the replacement property was purchased within 3 days of each other. So kudos to Teresa's team because they're the ones that turned around that exchange. Also, the state of California makes it more difficult than most states to do exchanges, but the team was able to work through that with no problem. And the last thing, they weren't sure how much money that they were going to need from the spouse's IRA. So that kind of kept changing to the 11th hour. But in the end, the clients had a successful closing, and it was one that the team was able to do in just a few days. Sasha, do you have any questions for me?
Thanks. I was figuring my mic. Thank you, Amanda. Yeah, I do have a couple of questions. So, obviously, this is just going to be your opinion, but why don't more people combine IRA funds when they do a 1031 exchange and purchase a more expensive replacement property?
Yeah, so with IRA properties, there's restrictions that it has to be strictly for investment purposes. So if an exchange client is looking to purchase a property, if they ultimately want to live in it, they wouldn't be able to do this because their IRA is an owner.
Okay. And
so it really has to be an investment property.
Could you say that again? I'm sorry, I spoke over you.
Oh, no, that's okay. Just wanted to say, so it has to be an investment property. So sometimes in 1031 exchanges, they'll do an exchange and eventually, years down the line, plan to live in it. Well, if an IRA is a partial owner in this transaction, then, you wouldn't be able to do that because it's got to be strictly for investment purposes only.
Okay. Are there any other reasons why it doesn't make sense to combine the two?
Yeah, some people think that they can partner with their IRAs to get financing, but they don't understand that the IRA is actually a separate buyer and owner, and it would work against them in the exchange. So if a client does an exchange for, let's say, $250,000, and they want to buy a new property for $250,000, but they wanted to use $75,000 in IRA funds so that they don't have to get financing, it won't work because they actually wouldn't be equalizing their exchange. That would only mean that the purchase they would only equalize $175,000 through the 1031, since the IRA would be acquiring that remaining $75,000.
Okay, well, that's great. I've seen, just the panel members doing a fantastic job of answering questions on the fly through the chat feature, and I don't see any unanswered questions at this time. Actually, there is one. Did I hear that in a Roth property you could use or live in it? It should be for investment purposes. That should be the intention. There is a way to eventually live in the property. It should be for after retirement. And I can reach out to you, Mark, to give you more information on that. So I think everyone, thank you so much for sharing your knowledge and experience. And we will be reaching out if any other questions happen to roll in here. Just wanted to wish everyone well and stay safe, and thank you for your business. And if you're new to Midland, welcome. We'd love to work with you. And thank you, everyone. And this presentation has been recorded and will be sent off to everyone that registered for the webinar, so you can listen at your own pace. So everyone have a good day.